How's it going, everybody? Stas here. Welcome back to another video. So today we're going to be going over the Buffett indicator, coined by the legend himself, Warren Buffett. And I also want to break down the Shiller PE, which I have admittedly talked about before here on the YouTube channel, but I figured why not go over it again here alongside the Buffett indicator, as we are seeing stocks near all-time highs, and one could argue that stocks are very overvalued right now. So if you guys find value in this video, hit the like button, subscribe, check out my Patreon down below if you all want my real-time buys, sells, call-outs, morning update videos, plus more. And let's get right into the video. So this is a chart of the S&P 500 over the past 20 years. And this is actually not the S&P 500 index itself. It's SPY, which is an ETF that tracks the S&P 500, but essentially it's the same thing. And you guys can see SPY has gone from $67 back in March of 2009 all the way to where it's sitting right now at over $440. And that's so many doubles that I can't even count them in my head. All you guys need to know is the markets have gone up a ton. And just in the last year alone, pretty much ever since the COVID crash, the markets have doubled. And it's been a little bit over a year, but the markets have gone from 218 back in March 2020 to now, like I said, 440, which if you guys can do simple math, 218 times 2, what is it? It's 436, which we're now at 440, which means we have doubled. So let's talk a little bit about the Buffett indicator, the Shiller PE, as again, the markets are arguably overvalued, and we've seen such a ridiculous rally here over the past year and a half, and the markets have done very well over the past 10, 12, 13 years. So let me pop it up. Give me a second here, guys. Let's go to Safari, and let me shrink my face a little bit so we can see exactly what is going on here. So let's talk. The Buffett indicator, as you all can see up here, is the ratio of total United States stock market valuation to GDP. As of September 30th, 2021, which was about 8 days prior to me filming this video, we calculate the Buffett indicator as aggregate U.S. market value, 53 trillion, divided by the annualized GDP, which is a tad under 23 trillion, and that comes out to 232%. And by our calculation, and by our, I don't mean me, this is coming from current valuation, or rather currentmarketvaluation.com. The calculation is currently 85% above the historical average, suggesting that the market is strongly overvalued. These are historical all-time highs. However, with interest rates at historic lows, there is reason to suspect that, quote-unquote, this time may be different, which we've heard many times in the past, but that's a decent point. And interest rates have been near zero for a long time, not just recently in the past couple of years. I mean, it's been the story for over a decade at this point, other than a couple of blips where the Fed tried increasing the interest rates, but we're not going to talk about that in today's video. And as you guys can see here, this is a very important chart. This is the Buffett indicator, which obviously we're talking about right now, and this is the historic trend line. You guys see the line running across the middle of the chart. Let me make sure you guys can see it. Yup, you guys can see it. That is the historic trend line, and right now, look how much higher we are compared to the historic trend line. I mean, the past... well, you could argue, well, it's not even arguable. It's a fact. You guys can see it here on the chart. In 2010, when we saw that dip in the markets, we had a point in time where the indicator was actually a bit lower than the historic trend line. But pretty much ever since 2012-13, we've been moving higher and higher above the historic trend line. And now September 30th, as of September 30th, 8 days ago, we are so much higher than the historic trend line. That is why people are saying, at least in terms of the Buffett indicator, markets are overvalued. Again, we're at 232% ratio of market to GDP, 85% higher than this historical long-term trend line that dates not only back 10, 15, 20 years ago, guys. This dates back to 1950, at least this chart that I'm looking at right here. So let's take a look at how this is actually calculated a bit more in depth. The most common measurement of the aggregate value of the U.S. stock market is the Wilshire 5000. This is available directly from the Wilshire, with links down below in this particular website, with monthly data starting in 1971 and daily measures beginning in 1980. The Wilshire Index was created such that a 1-point increase in the index corresponds to a 1 billion increase in the U.S. market cap. Per Wilshire, the 1-1 ratio has drifted, and as of December 2013, a 1-point increase in the index corresponded to a $1.15 billion increase. So I don't want to get too in-depth into this, but the moral of the story is, guys, look, right now, according to the Buffett ratio indicator, whatever you want to call it, we are very overvalued, and the brief way of calculating this, again, is looking at the aggregate U.S. market value, the total stock market cap, divided by the annualized GDP. And as long as we're above this historical trend line, which you guys can see this chart in many different websites and many different forms, as long as we're above the trend line, we are overvalued. And I want to talk about, like I mentioned in the intro, the Shiller PE as well. Let's take a look at the Shiller PE, which is very interesting, and I've mentioned this before many times. And the Shiller PE, also known as the CAPE ratio, also known as the PE10 ratio. I don't know why it has so many names. I mean, why not just stick to one name? I mean, we have the CAPE, the Shiller PE, the PE10. These are all the same thing, right? This is a valuation measure usually applied to the U.S. S&P 500 equity market. It is defined as price divided by the average of 10 years of earnings. It's kind of a moving average indicator adjusted for inflation, and is calculated as follows. Take the annual EPS of an equity index such as the S&P for the past 10 years and adjust these earnings for inflation using the CPI, and adjust the past earnings to today's dollars, and then take the average of these real EPS figures over the 10 years and divide the current level of the S&P 500 by the 10-year average EPS, and then boom, you got the CAPE ratio. In other words, in layman's terms, it's pretty much the trailing 10 years of earnings smoothed out, averaged out, adjusted for inflation. That's pretty much what it is. Very simple. And you guys can see as of now, let me make sure you can actually see this. I'll move my face over here. As of now, the Shiller PE is at levels it hasn't been at since the dot-com bubble. I mean, let me pop up the 20-year Shiller PE chart. Actually, let's do all time. 20 years is better. Gives us a little bit more of a narrowed down time frame. Back in 2001, the Shiller PE was 30. Actually, let's go to all time and see what it was in the dot-com bubble in 99, because the 20-year doesn't show that. 99, look at this. In 1999, Shiller PE was at 42. And then we saw the bubble pop, and we can see what happened in the years after 99, 2001, 2, 3, all those years. We got a very big pop in the Shiller PE from 42 down to about 22. Then we consolidated 22 to 25, 26 in 03, 04, 05, 06, 07. And then you guys remember what happened in 07, 08. Boom, another big crash. Shiller PE went from 26 down to about 13 in 09, and that, in hindsight, would have been a fantastic time to buy stocks. And then from 09, 13 Shiller PE, now we're all the way to 38 again, pretty dang close to where we were during the dot-com bubble, meaning stocks are decently overvalued right now, according to this metric. And you guys can see, I don't know if you can see this actually, but the all-time historical average is 17.2 for the Shiller PE. Now, again, we're at 37. So we're very high, a lot higher than the historical average. And pretty much, if you're looking at this all-time chart, guys, we have not been this high except for, like I mentioned, the dot-com bubble in 1999. So these are two valuation metrics that are very interesting. I mean, the Buffett indicator, we're overvalued. Shiller PE, we're pretty dang overvalued. So when I'm looking at the markets right now, and I always tell you guys, I'm not a financial advisor. I'm not here to tell you what to do. But when I'm looking at the markets myself, I am not looking at plowing all my money. Well, okay, let me take that back because I'm still investing, but I'm also keeping some money on the sidelines, right? I'm not ignorant to the fact that we're at all-time highs and that I think, we can't go down. I'm not ignorant to the fact that we can go down. But I still want to be in the markets because time in the markets is better than time in the markets. A lot of people always are like, oh, the markets are overbought, they're overvalued. If you guys look at headlines from 11, 2012, 13, 14, 15, there's always people calling for a crash. So if you weren't, if you were to take those words literally every single year and you stayed out of the markets, you would have missed out on a lot of returns. So as markets do get overvalued, though, which, again, we talked about how they could be right now, we have to be cautious, but it doesn't mean that we can't participate either. We just have to look for the best deals out there within the overvalued markets, if that makes any sense, right? Look at stocks that have a strong moat, have cash flow, they have earnings, they make money right now, the valuation isn't too crazy, and stick to those. That is kind of what I've been doing. And on top of that, have cash on the sidelines so you're ready to take advantage of the next crash, of the next big market opportunity when we do see a downswing, which, again, nobody knows when that's going to happen. Just because the Buffett indicator is screaming red, just because Shiller PE is overvalued, it doesn't mean that we're going to crash tomorrow. Nobody knows when this is going to happen, which is why, again, time in the market's better than timing the market. Having money put to work is a good idea, but also having the dry powder is also a good idea. So as of now, guys, that is kind of my thought process. I'm still in the markets. I'm still working, put my money to work, trading, selling options, all that good stuff, but I'm also being a little bit defensive at the same time. I own gold. I have precious metals. I have cash. I have a little bit of Bitcoin, even though that's a bit, what's it called? Even though that's a bit, what's the word here? Controversial. Whatever. It doesn't matter to me. I have a little bit of everything, and that's kind of how I'm looking at it. So let me know your thoughts. Drop me a comment down below. If you all enjoyed the video, make sure to hit the like button as well, and subscribe. If you guys want more content, make sure to subscribe and check out my Patreon if you want to support the channel a bit further. It's not free, but you do get a lot of perks. You get my real-time buys, sells, call-outs, morning update videos, Discord access, exclusive content, early access to content. All of that is on Patreon, linked right down below. Make sure to also get your $30 from M1 Finance, your 2 stocks from Webull. Those are also linked down below, and that's it. I'll catch you all in the next video. Thanks for watching again. As always, keep crushing the markets. Stay safe out there, guys. Peace out.